Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value, published by Stansberry Research. Today we'll talk with my friend Chris Pavise of Broyhill Asset Management. We talked to Chris 3 years ago. The world has changed quite a bit since then. I'm very curious to see how he's been doing and what he's doing now. In the mailbag today, lots of questions about everything from rural real estate to the 1987 crash, most of them from one guy. And remember, you can call our listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. For my opening rant this week, the crypto crash. Let's talk about it. That and more right now on the Stansberry Investor Hour. Well, among other things this morning, the S&P 500 officially going into a bear market, minus 20% from its high. We also see headlines about the crypto market crashing, specifically the website Binance, the crypto broker, really, and Celsius is another one. They've halted redemptions and withdrawals. This is a bad sign. This is a very bad sign. Celsius lets their Bitcoin holders, their customers, lend out their crypto, and it has blocked them from withdrawing their money due to what it calls extreme market conditions. And sure, if people are lending based on crypto values, they've lent. What they've lent is worth a lot less now, a lot less, right? So that can create a problem if you've borrowed crypto and you're buying something else. You might owe a lot more than you currently have. Anyway, we don't even need to know the specific problems. All we need to know is that the crypto world is in such a crisis that, you put your crypto into this account and you can't get it out now, right? This is like when a broker fails and they say, hold on, we're hanging on to your money for a while, and then you go through this whole process and maybe you get it back and maybe you don't. I mean, usually I think you do, but, sometimes you don't. And what we're finding out, if we just take a step back from this, here's what is happening. This is exactly like the dot-com crash, right? Because the technology was new. Lots of people came out with all kinds of ideas about how to exploit it. I think I know at one point there were 16,000 cryptos in the world. And that's kind of a lot, right? And there were thousands of dot-com businesses, right, before the peak in 2000. And then in the bust, after the boom, most of them disappeared. You had to wait till the bust to find out who was real and who wasn't. Some people said Amazon wasn't going to make it. Well, obviously that was wrong. And all the companies that made it, some of them have done incredibly well, and some faltered. I mean, obviously it's a mixed bag even after the bust, but you really find out what the great businesses are and the really robust ones are in the bust. And that's what's happening now. And I think it's the early part of the crypto bust, because I think it's the early part of the bear market after the mother of all bubbles in all recorded history. So, as we speak, bonds are falling, stocks are falling, crypto is falling. It's a classic bear market scramble for cash. People are scared and they want to go to cash. They don't trust crypto. They don't trust stocks or bonds or anything but cash. And I've mentioned this. I've told people, I've continued to tell Extreme Value readers and you, our podcast listener, and others who read the Stansberry Digest, to hold cash, even though we're seeing, the latest inflation number, 8.6%. So that means over the past year, your dollar has lost at least 8.6% of its value. Some people will say more than that, because that 8.6% is measured by the official CPI, and people have a problem with that. And I don't know that they're not correct. They could be correct about that easily, I think. Um, so your dollar has lost at least 8.6% of its value versus the goods and services that you buy. And yet, when the doo-doo hits the fan, people rush back into dollars. They get really burned out watching the value in their account deteriorate, and they say, I got to sell it. And what do you get in this world 80% of the time, all over the world? 80% of global transactions are in US dollars. And so that's what's happening. People are getting out. They're afraid. Crypto's crashing, inflation's hitting 40-year highs, et cetera, et cetera. And, there's the simple fact that valuations are still really high, even as I'm speaking to you, with the S&P 500 now officially in a bear market. It's still nowhere near cheap. We're just above or right around the peak valuation of the 1929 bubble. So that's one of the three biggest of all time. This one, the .com 2000 bubble, and 1929 bubble. Three biggest, most overvalued, super expensive moments in all stock market history. And we're still up in bubble territory with stocks getting hit this hard. And I told people in my latest Stansberry Digest, Mark Hulbert is a guy who does a lot of good research, various kinds, and he's got these 8 indicators that tell him stocks aren't cheap 8 different ways. They're still expensive 8 different ways. And I've talked about the economist and portfolio manager, John Hussman. Stocks are still extraordinarily expensive 5 different ways. So that's 13 different ways that stocks are really incredibly still expensive, even though the S&P 500 is now down 20%. And the Nasdaq must be maybe 30 by now. I didn't glance at that one this morning, but they're all getting absolutely murdered. And so people are rushing into cash, and that's where we are. We're in a bear market. Stuff is falling apart. Crypto's falling apart. I think we'll find out in the end that Bitcoin and maybe Ethereum and maybe a couple others were the real deal. They're really worth something. They really fulfill a genuine need in the world, and they work, and they're good to own. Now, if you look at a chart of Bitcoin, clearly, like, if you take the chart back 5 years, to 2017, of course, there was the big run up at the end of 2017, and then it crashed back to like 3,000 or something over the next like year or so. And that was the bottom. And then we, rushed up to, what was it, 69,000, I think, at the peak. I look at the price of Bitcoin on my little Coinbase app, and the peak there was 69,000. So, and you had these 2 big runs. One was up to about 63 in April of 21, and then you crash back down to around 30, and then back up to 69 in November of 21 last year, when also, the Nasdaq peaked in November too. That was a big moment for all the most speculative tech garbage that hadn't crashed already, right? There was a big peak in early 21 when, the ARK fund, the ARK Innovation ETF peaked, and, cannabis and clean energy and SPACs and all that garbage peaked then. And then you got the Nasdaq peak and in November, and that's when Bitcoin peaked as well. And now we're down, just crashing straight down. It sort of fell off the bottom, right? Because there was a bottom around 29 or so that was established in July of last year, and we're through that. And now we're at around 23,000 as I'm speaking to you. And I think the bottom is somewhere between 3,000 and 12,000. I don't think we're there yet. There's a little bit of, if you read charts, maybe there's a little bit of support around the 20,000 area, but there's a lot of noise between 12 and 3. And I think it finds a bottom somewhere in there. And I think it takes longer than this. One of the things that we've gotten conditioned to over the last 12 years is buying dips. And, some people will say the Fed having your back, enabling you to buy the dip. So what happens in a big, nasty bear market is early on, there's lots of kind of shallow rallies. We just had one, that was 7 or 8% or something. And I covered this too in the past couple weeks here and in the digest, right? The early rallies are shallow because the market doesn't have to work very hard to get you back in, right? You will still want to buy the dips, but then you get killed over the course of 6 or 12 or 18 months. And those last rallies have to be 15, 20, 25%, maybe more to entice you back in, and you still get killed. And then there's a huge panic and a huge capitulation. The volumes go through the roof on a bunch of down days, and then the market finds a bottom when nobody wants stocks, nobody wants whatever it is that's in a bear market, and many people will walk away and never return. A whole generation will walk away at that point, and they won't be back in until there's another huge bubble in 10 years. That's just the way it works, and I think that's the way this is going to work out. And there will be probably 5 or 6 rallies on the way down. And the first ones here are shallow, 7 to 10%. And then we'll get the bigger ones after people really get crushed when the market's down 40, 35, 40, 50%, something like that. And if John Hussman is right, we've got another 40 or 50% from here. So hold on to your hats. If this is the real deal bear market, which I suspect that it is, and I said that before the S&P 500 went into what they call an official bear market, minus 20% today, then, there's more pain to come. And on that sunny note, let's move on and let's talk to my friend Chris Pavise, and we'll talk about what he's doing now and what he's been up to the last few years. Great guy, great investor, very thoughtful and measured and informed. Can't wait to talk with him right now. Let's do it right now. Last year, when most investors were watching their stocks plummet, one Wall Street legend had an unfair advantage that was identifying winning stocks with massive upside, like Riot Blockchain before it shot up 10,090% in less than 12 months, Digital Turbine before it shot up 789% in 8 months, Overstock.com before it shot up 1,050% in 4 months, and more. Clients have paid as much as $5,000 per month to see this kind of research, but today you can get a glimpse at his system, the Power Gauge, absolutely free. It's a new way to see which small stocks could soon be rated a buy across Wall Street and shoot up. By using a secret so powerful, CNBC's Jim Cramer said, even he doesn't want to bet against it. This Power Gauge comes from the legendary Mark Chaikin. Mark is the creator of one of Wall Street's most popular indicators, a system that appears on every Bloomberg terminal in the world, and it's used by banks, hedge funds, and every major brokerage site. He spent 50 years on Wall Street, survived and thrived in 9 bear markets. 9! Built 3 new indices for the NASDAQ, where he once rang the opening bell. But today, Mark has turned his back on Wall Street and wants to show you how this unfair advantage works. Right now, you can get a free in-depth look at how his Power Gauge system works, a way to type in any of 4,000 different ticker symbols and see exactly where the stock is most likely to go next, and in any type of market. Simply go to www.trypowergauge.com for your free look. Again, that's www.trypowergauge.com. All right, it's time for our interview once again. Today's guest is Chris Pavise. Chris is a friend of mine that I see every year. I see him at least once a year at the ValueX conference that we all go to up in the mountains every summer. Chris serves as president and chief investment officer of Broyhill Asset Management. He leads the firm's research and investment process focused on idea generation, investment strategy, and portfolio construction. In addition to his role at BAM, Chris serves as vice president and chief investment officer of BMC Fund and the Broyhill Family Foundation. He's a CFA charter holder, past president of the board of the CFA Institute's North Carolina Society, and current member of the CFA North Carolina Society Strategic Advisory Board. He is still considered an official Southerner in training, understands the importance of sweet tea and the multiple meanings of bless your heart. Well, bless your heart for being here, Chris. Nice to see you again.
Thanks, Dan. Good to see you also. Thanks for having me.
You know, one of the reasons I wanted to have you, it's been a while since we had you on the show a while ago. And like the world has sort of turned upside down and then, halfway right side up again. And I'm just curious. I've gotten a variety of stories about what people have done in the past couple of years, what they're doing now with their money and clients' money, and I was just curious to get your ideas as well. So, first of all, like, what was the pandemic era like for you? Or I mean, you manage Broyhill money, so the money's not screaming out the door, right? You're not getting calls every day, I assume.
No, we're fortunate in that regard. The Broyhill family office has been around since 1980, so we're fortunate to have a somewhat quote unquote permanent capital base in that regard.
Mhm.
We've been selective with regards to the external investors that we've worked with over the year, and that's been by design. I think that's often one of the most underappreciated aspects of this business is
Yeah.
the importance of having good clients. Um, I can tell you in March 20, the only calls we got, which I could count on one hand, were from our best investors asking, when they should send us more money.
Wow.
So no calling, no panicking, and I could say the same thing for today. Although it certainly helps today that we're actually making money this year. That was not the case in March 20 when everything kind of fell. Correlations moved to one,
Hmm.
but we've been doing the same thing all along, and markets just seem to have gone our way, or at least as you said earlier, are on their way to making more sense again.
Right. So maybe let's orient the listener about your style. So, like, if I met you in a bar, which we've been in a lot of bars together, if I just met you in a bar and I said, what kind of investor are you? What would be your answer?
Yeah, so we are opportunistic. I would say value oriented investors. Value investing means a lot of different things to different people these
Yeah.
days. To most of them, it's a bad word, and few would even admit to being value investors
That's
anymore.
right.
That may be beginning to change. We hope it is. And so what that means is, we try to buy assets for less than what we think they're worth. Sometimes that's a great business trading at a good price. Sometimes it's a good business trading at a great price. Historically, the situations that we've gravitated to fall into one of three categories. So they're something we'd call value with a catalyst. So it's a name that's cheap for a reason, and we see something on the horizon to unlock that value. So that could be a pending transaction. It could be involvement of an activist investor shaking things up at the company. It could be new management, inflection point in the business itself. There could be any number of things. Second thing is what we call temporary dislocations. So sometimes these are one off, right? It's a good business that hits a bump in the road. Most of us tend to extrapolate that bump forward, and but more often than not, good businesses recover, and those bumps are just temporary, right? So if you could buy a good business on temporarily depressed earnings, right, on a temporarily depressed multiple, and those earnings rebound, and the multiple re-rates higher, you get double bang for your buck on the upside. Um, COVID, right, was one big temporary dislocation. So basically, everything we bought in March of 20, Q1, Q2, Q3 of 20, it would fall into that category. And then the third is just really a catch-all. Sometimes it's a thematic type of investment where we're seeing something top down. That's rare for us. Other times it's just a deep value name that may lack an obvious catalyst, but we just think it's a good business that we're comfortable owning for several years, and we think it's too cheap for one reason or another.
Well, God bless you for for maintaining the value focus. There are precious few of us left in the world. You must have had a hell of a 2021 with, the client base being what it was and their interest in investing in March and so forth. Um, and your focus being what it is. You must have had a hell of a good 2021, I'm guessing.
Yeah, I mean, there were, right. I mean, some of the numbers we saw in 20 and 21 were just spectacular, right? I mean, I can count, I mean, just off the top of my head, several managers that were up triple digits over that time period, in either or both, right? 2020 and 2021. That was not us. We don't typically run with that much volatility. Most of our clients have already made their money, so they're not looking for us to swing for the fences. They're looking for us to make sure they keep it, and so that they let us worry about it so they can sleep at night. That said, right, we've been putting up. I mean, we've been happy with the performance. Clients have been happy with performance. I'd say it's been consistent over the last several years. Drawdown in Q1 of 20 was a fraction of what the market experienced. And we rebounded fine through the rest of the year. Last year we did have a good year, but really in terms of, I mean, that's great to put up numbers in absolute terms, but really we're most proud of what we've done in the last year, specifically when markets have turned and the majority of investors are losing money. And I think, right, when you look at managers, many investors make a mistake of chasing, right, the most spectacular returns, and so they get quickly attracted to managers that put up great numbers in bull markets, and ignore how they've performed over bear markets. And really today, a lot of those investors haven't seen a bear market, right? I mean, the majority of investors today were not around for either the financial crisis, let alone the tech bubble, which I think is the best analogy to what we're seeing today. And so, having lived through that and managed money through that gives us, well, a bit of gray hair, or in my case, the loss of all of it. But right, we also get that experience to manage through those things. But uh, yeah, the most spectacular returns, for the most part, that we saw in 2021 are posting the most spectacular losses this year. And I'll give you an example of two securities. There a couple of years ago, I was at an investment conference speaking on a panel, um, and the person alongside me was speaking very highly of Kathy Wood at ARK. And right, and for a year or two, she was spectacularly right. And meanwhile, I was presenting a very unpopular idea, and it was sort of the anti ESG trade, and why we were so heavy in tobacco stocks. And if you look at the performance of both of those businesses over the last 2-3 years, right? Like the turtle has outperformed the hare over the long run, right? The hare was very fast out of the gate, but has then given it all back and then some. And meanwhile, right, owning a business like Philip Morris or Altria, and you're clipping high single digit or low double digit temporarily dividend yields, right? If you're clipping an 8 to 10% dividend yield, you don't need much, if any, in terms of capital appreciation or price change, right? To compound capital pretty nicely over time.
Right. I was thinking as you were describing your style versus sort of what screamed in 2021 and then collapsed. Since 2018, it had to have been kind of difficult to be the guy looking for lower volatility and, thinking about wealth preservation. That's been a tough road for the past 4 years, hasn't it?
It has, and I think it goes back to how people think about value and how people define value investors, right? Like, I think the historically folks have thought about value investing as what we'd call a statistical value, right? Like buying low price to book or low price to earning stocks. And if you're just investing on that basis, you've gotten absolutely murdered over the last 5 years. And maybe you're doing better, maybe you're having a decent year these last 6 months. But you lost a lot of money and probably a lot of investors in the 5 years leading up to these last 6 months. Um, like we said earlier, we take a broader approach. So we're not just looking at how something screens on the surface, what the PE multiple is, what the price to book multiple is. We're trying to understand why something is undervalued and why that might change. We're trying to understand why what the market's view is, what the consensus view is, how that compares to our own, and what may make the consensus come around to that view. And we're looking for situations that, in many cases, have a discrete catalyst to realize that value. You know, Most obvious example today, our largest position in the book is Activision. Microsoft made a bid to acquire the company at $95 per share. Activision today is trading closer to 75, right? It's 77 and change. I mean, that's north of a 20% spread on a deal. So the market's telling us, that deal has 50-50 odds of going through. We'd probably say the true odds are closer to 80-20, and so we're willing to take that risk. And for your original question on managing money and reducing volatility in the portfolio, right? Situations like that are a great way to reduce volatility in the portfolio because the you know regardless of what the market does, that stock is going to trade. It's sort of pegged to that $95 offer, and it's going to trade around that offer depending upon the news cycle and what the political climate looks like.
Right, and in the just, past, I don't know, several years, decade, call it, like, risk arb kinda sucked because, the spreads they were non-existent, and now,
Yeah.
20%, I mean, 50-50. I think, Chris, I think that's generous. I think 20% says this ain't gonna happen.
And I think,
Yeah.
Dan, you're spot on. Like, I think that's also the reason why the spreads are so wide today.
Mhm.
A lot of money has left that sector of the market because it hasn't been very profitable, and so that's number one. Number two, a lot of the traditional players that would be involved there typically don't like taking on political risk, which is harder to handicap, right? If you look at this deal on just a rational legal basis,
Mhm.
there's no way it should be blocked. It should, right? Historically, vertical integration has had no issues clearing antitrust. We saw that with the last time we were involved with a big deal of this nature, which was Time Warner and AT&T, and T, and we had a very large position in Time Warner going into that deal.
So, Chris,
The
real
other
quick,
similarity with that deal, by the way, is
just for the listener's sake, let's just make it really plain, like, vertical integration, meaning Microsoft doesn't own, like, 50% of the gaming market, right? So them buying Activision should not be a legal problem. I just wanted to make that clear to the listener, but I'm sorry, continue. Yeah.
yeah, no, thanks, Dan, and that's a good example, right? So it's not two video game companies merging, right? Or if we go back to the Time Warner example, which is even cleaner, right? It's not Comcast and Charter merging, right? Or Netflix and whoever would be the next largest distributor, right? It was a merger between a content producer and a distributor. And that's exactly what we see with Microsoft Activision, right? You can think of Xbox platform as a distribution platform for the content, Activision providing the content. Historically, those have had no issues with antitrust. And that proved to be the case with Time Warner. But back to Activision, right? It's more of a political issue. Big tech has been in the crosshairs of DC for several years now, and so people don't know how to handicap this one and don't want to be involved. The other factor pointing to larger than natural spreads today is just a lot of funds are struggling. Right, you're seeing headlines week after week, if not daily this year, of funds down 30, 40, 50% or greater. And so they're reducing risk, reducing exposures, and the last thing they want to do is get involved in a situation with a risk of something else blowing up in their face. And so you don't have folks willing to step in here to close that gap, which is great for us. And again, the only thing, the one thing that differentiates us from a traditional merger arb investor, which we are not, is the fact that we're value investors, right? So we get involved and are comfortable taking a very large position in situations like this. When the deal closes, we make 20% in about a year, ideally. It could take longer, but generally that's how we're thinking about the upside. The downside, the deal breaks, and we will only be involved when we're comfortable owning the underlying on a deal break, right? So if this doesn't go through, we think Activision is still worth a lot more a few years from now than it is today. And so we're okay either way, right? Like we'd love to make a quick 20%. Um, and if the deal breaks, yeah, we'll see some short term pain. Some of that will be offset by a $3 billion breakup fee that Activision will take in. But there will still be some unwind in that position, but we're comfortable with that risk and we're comfortable owning the underlying.
I'm sold. I wanna buy it right now. So, Chris, are you comfortable talking about any other specific names? Like, I mean, you mentioned these 3 areas, catalyst, temporary dislocation, and then your catch-all. You got anything from any of those categories that you wanna share?
Sure, I'd say
Even just as an example, it doesn't have to be current,
yeah, no, I'd say that probably the best example of a temporary dislocation is a position. It's still one of our largest positions today. It's a position we bought in, I believe, in June of 20. Um, it was obvious to us that the aerospace and travel and hospitality industry were going to be clobbered by COVID, which it was obvious to everyone. Um, we spent a lot of time on aerospace and airlines. Actually, started nibbling on a couple in February and quickly reversed course when we realized things were going to be a lot worse than they initially looked. So we minimized losses there. But the work there led us into a different segment of the market, and we wound up spending a couple months studying the airport sector. What's interesting about airports, first and foremost, is while airlines are notoriously awful businesses with notoriously awful balance sheets, um, the airport sector is a phenomenal business. You typically have large institutional money, right? Thinking about it as sort of an infrastructure play. It's a great inflation hedge. You've got real assets. And the 3 airports we own did not we had net cash on the balance sheet when we bought them. So there was negative net debt. So balance sheets were great. There was no issue, right? Regardless of how long travel shut down, right? They would burn capital a bit just keeping the airports up to date, but they did not have the debt that airlines needed to service. And so when we looked at the sector, one thing that jumped out to us, if you plot all of the publicly traded global airlines on a chart and look at various metrics that you'd look at when analyzing airports. So, passenger traffic, EBITDA per passenger, sales per passenger. You can look at the regulatory environment across all of those companies, which differ from airport to airport and region to region. And then you look at margins. You look at the mix of revenue between like fee-based aeronautical revenue, so that would be airlines paying the airport a fee to use the service, versus a more variable revenue source like charging rent to retailers inside the airport or parking or hotels on the premises. If you do all that and cover up the names and regions of the airport, you'll see a group that look fundamentally much stronger than most of the sector. Most of those businesses are in the East. And so, right, people are making a bet on growing traffic, growing GDP per capita in places like China, EM, Middle East, where that's been the biggest source of demand. Um, they're also priced as such. So the Sydney airport in Australia recently transacted. I think the bid was like 25 times EBITDA. And when we looked at the sector from going back to 9/11 through today, that's about what they go for. Multiples have creeped up over the last 10 to 20 years from the mid teens to the mid 20s of EBITDA. Um, there were three airports that jumped off the map that, again, covering up the names and the locations, they were growing faster, higher returns on capital, higher margins, better profitability. I mean, on almost every metric, and yet they traded at single digit multiples of EBITDA. And these are all three airports are located in Mexico. And so we still own those today. What's interesting, and the thesis at the time was we thought um, leisure traffic to Mexico was likely to pick up earlier than most. And if you think about the world today, which is just a coincidence, it was not on our radar at the time, right? Like China's off the map, Europe is off the map due to Russia. Um, and so all of a sudden, LATAM is the cleanest shirt in a dirty laundry basket, right? And so LATAM has actually had one of its best quarters on record in Q1. Airport traffic in Mexico is already north of where it was pre-pandemic. Margins are already higher than where they were pre-pandemic, and so and yet those things still trade at single-digit multiples of EBITDA. So I think they still have a way. We still own them. The earnings recovery has happened. I think there's still room for traffic to recover, and so we'll still see cash flow continuing to drop to the bottom line. But I think they have not re-rated yet, and I don't see any reason why those businesses should trade at single digit multiples, or maybe at most, depending upon the numbers you use, you might see 10 to 12, right? But it's still less than half the rest of the where they should trade.
Yeah, that when you said 25 times EBITDA, I was like, well, damn, man, airports are the SaaS of, real estate or something. It's that blew me away.
Yeah, I mean, if you think about it, right, it's they make most of their money. So the fee-based business is regulated, right? The Mexican government, they sign an agreement. It's typically a 5-year agreement with the Mexican government that basically sets the rate that they can charge the
Mm,
airports. But there's no regulation on what they can charge you and I, or what they can charge a storefront in the airport. And if you think about that from the perspective of retail, right? Everybody knows, like, brick and mortar has been collapsing for years,
mhm.
right? I mean, e-commerce is taking share. Brick and mortar has been struggling for as long as we can remember. But airport brick and mortar is prime real estate, right? You've got an affluent client base and you've got a captive
Yep.
audience. And so the rents they can, like, that is just prime retail real estate, and it shows through in the numbers and the rents that they can earn there.
Yeah, I'm thinking as you're talking, like, I've done a fair amount of my brick and mortar shopping, like, in airports in the past couple years or whatever it's been, and not, hardly anywhere else. But and it strikes me, like, when I go to an airport, I've been thinking about just walking through an airport, all the employees that I see are, retail and airline employees. Like, when do, maybe the folks emptying the garbage or something, like, I rarely see an actual airport employee, which is interesting to me.
Yeah, I mean, like the rest of hospitality, there's certainly been some cutbacks, and most of the management teams will tell you a lot of those cost savings. They cut out costs permanently. We wouldn't be surprised to see much of those costs come back as traffic fully recovers, but there will be some savings.
Right. So, I mean, hospitality is like people serving people, but this is like, I don't know, it's like they own the casino or something. It's great. It's a great idea. The casino is the airport, the airlines are the gamblers, right? It's cool.
Well, and the other beneficiary, particularly in this environment, is real assets are a phenomenal inflation hedge. Right? And so, just watch ticket prices over the last couple. Yeah, if anybody that's been on a airplane over the last year or two since COVID, take a look at what you're paying there relative to what you paid pre-COVID. Um, and yeah, typically real assets like airports, physical assets. I mean, it's your classic right, Warren Buffett toll booth, toll bridge business. And they pass those prices along along the customers.
And it makes me wonder, is it as difficult in Mexico to build a new airport as it would be in the United States?
Yeah, that's a whole nother story. You've seen a bunch of messy political battles around airports being developed over the last few years. But yeah, it is. That's the other nice thing about airports. It was similar to our a prior investment in theme parks, which are not phenomenal businesses, but they're great investments at the right price. Right, they're just, the assets there are very difficult to replace, and to get zoning and put a new park in place. Right, you're not going to have competition anytime soon, if at all. And the airport market is very similar in that regard.
I'm glad you mentioned theme parks, because I want our listeners to know Chris is like a dedicated, voracious reader, lifelong learner, and and you gave a presentation one year up there in the mountains where you were doing like a post mortem, and I was like, wow. Yeah, I mean, I was impressed with that because nobody ever does that. Why do that?
I think, if I remember, Dan, that was maybe the presentation we gave. Yeah, this was probably going back 5 years plus, right? That we gave a presentation on like creativity and idea generation. Is that the one you're referring to?
Probably is. I'm probably mixing some things up in my head, conversations plus presentation or something, but I don't know, I just remember you talking very candidly about, what went right, what went wrong, and how you're thinking about it, and I was like, it's impressive. People don't talk about it ever, and so to mention it all,
Yeah,
speaks to you well.
it's well, thank you. I think, yeah, this industry sometimes doesn't suffer from a lack of humility. Maybe that'll change right after this year. We haven't seen it yet, but yeah, I mean, we're the first to admit mistakes, and that's the only reason. That's the only way to learn from them. And so we probably spend more time highlighting our mistakes internally as well as to our investors, as highlighting what's working. And we do that to make sure that we don't make the same mistake twice.
Right. I think a good topic now for a lot of people. It was probably a better topic 6 months ago or maybe even a year ago with a lot of this stuff is when to sell. And I'm always curious to do that with value investors because, traders have a whole different way of looking at the world. We know when they sell, right? They use stops and it's all very mechanical. But when someone has done like the kind of deep work you're talking about, a couple months looking into airports and stuff, you get a higher sense of conviction. Some people take, bigger positions and they don't give them up easily because they're sure that they know the industry, they know the business. How do you think about selling in particular and kind of risk control in general?
Yeah, I would say that's probably one of the toughest things in this business, right? It's much easier to decide when to buy, and even if you buy early, right, like, you've got an opportunity to buy more, or you can leg into a position over time. Um, it seems easier to identify, right, when something is oversold, um, than when it may be overbought or overvalued. And like you said, it's very easy to fall in love with your positions. I can't tell you how many times over the last, let's say, 5 years, I've wondered if, or kicked ourselves for selling a position too soon. Right. But I, we have not changed the way we've thought about this, because I've also constantly questioned whether or not that was really the right lesson to have learned over the last 5, 10 years. Right. There's a generation of investors in the market today that truly believe if you buy a good business, you never have to sell it, and you should own it at any price. And it's interesting. I remember specifically, and shared this with the team recently. Um, I want to say this was back in 2020, 2021. Howard Marks published a memo where he shared an ongoing discussion he has had with his son, who is more attuned to the venture world than the value investing world, and it was a debate around this. And his son's argument is consistent with what we hear from most people in the market today is that, right, like you need to let your winners run. And you never want to sell a good business. Um, and I feel like that may have been the wrong lesson to have learned here. There are, we try to differ. So I guess one of the things we've changed, we try to differentiate between, before we go into a trade, if this is a business that we would quote unquote own forever, right? If this is a great business we're comfortable owning, and I think about it in terms of like if this is a business I'd buy for my son, you know, can we put this away until he's in college? Um, that's different than buying a business in, well, we'll use the amusement parks as an example, right? I don't think those are great businesses. But like I said, sometimes they're great investments. And so for those types of businesses going in, you need to be more disciplined as to where and when your exit price is because you don't want to hold on to those things forever, in our opinion. And so I think differentiating up front between the two is important. And you can give the former, right, those great businesses more room to run. That's a mistake we've learned from. So, for example, we owned, it's hard to believe this, right? But it wasn't too long ago that you could buy Apple and or Microsoft at single digit multiples of earnings, right? I mean, both are trading or were trading north of 30 times, right, recently. I would argue the businesses aren't very different today than they were when they were trading at single digit multiples of earnings. Some people would push back there. I would say they were not very different. Microsoft in particular, right? People would point to Azure and Office 365 being more subscription based, but those were on our radar when we were buying Microsoft at $45 after Ballmer left. Um, those were on our radar. They just weren't appreciated. Right now, they're very much appreciated. They're a bigger component of the business, but they're much more appreciated. Um, we, so we bought Microsoft and Apple at single digit multiples of earnings, and we sold both within, probably 12 to 24 months, up 50 to 100%, and gave up several 100% of upside, right? Like we want to avoid making those mistakes. And I think the lesson learned there is not own great businesses at any price, but you could give them more room to run, right? So if we bought it at single digit multiple of earnings and it re-rates to, from 10 to 15 times earnings, right? Like, let it run to 20. Let it run to 25. Like, you can make the argument that those businesses should trade at a premium, but there's a point where that premium gets extreme. And in hindsight, right, we've reached that point. Um, but really what it comes down to, Dan, is for every position in the book, um, we've got a scenario analysis, and when we position size, it's probability weighted rates of return, right? So we've got a base case, we've got a best case, and we've got a worst case. We think about what we think the business would be worth in each of those cases in 3, 5, 10 years down the road, and then we assign probabilities to each of those cases. And none of those things are static, right? Each of those things, both the assumptions in terms of fair value as well as the probabilities of each of those cases, is changing with new information we're getting in. And so we've got the whole portfolio on a piece of software that ranks our positions, right, on probability weighted expected return. And so as something rises in price, if you're not updating your assumptions and your assumptions haven't changed, by definition, your expected return on that position is coming down. And so our system would be telling us to reduce the position. And conversely, right, if something's falling in price that you own, and again, assuming that your assumptions has not changed, right, we're being told to increase that position. We don't do that dogmatically, right, but it's a factor in our decision making, and it certainly helps, right? It helps sort of institute a layer of discipline on when to sell. I can tell you, we've been trimming a position this year. Like I said, that's been very difficult to trim. It's been one of our best performers. We've owned it for 5 years. It's re-rated from 7, 8 times earnings to more like 13, 14 today. It's traded in the past as high as 20 something times earnings. The business is fundamentally exceeding expectations and has been for the last few years, although the market's just starting to recognize that. It's been tough to sell, but we've been trimming because, right, like the alternative is kind of keep going in there and nudging your assumptions higher to justify holding on to it. But you catch yourself doing that over and over again, and you need to pause and say, okay, like we probably need to be selling. We probably need to be taking some off the table here, right? But having that framework in place, right, to be sort of to be flashing red on the screen, forces you to think about it.
Being forced to think about it is a good thing, because I'm glad you put it that way, because, like, we're all human, right? I mean, everybody wants to keep the big winner they've got, and, everybody it's just human nature. Like, it's really hard to actually, I think it's kind of hard to sell in general, because people get married to these positions, and they get conviction on something that's down 50%, and then they get greedy and they want to hold something that's up 500%. um, and I guess my point here is, Chris, like, I've talked to a lot of people, from day traders, people who've just made a living trading, stocks and commodities and everything, to long-term value oriented investors. And this idea of having some kind of mechanical threshold where you at least stop and say, okay, either this has gone unbelievably swimmingly well, we need to think about it, or this is going against us, we must think about it at minus 20% or whatever it is. um, it's just interesting to me that the judgment there is not, we'll know it when we see it. It's, we won't know it when we see it. We need to force ourselves to do it. I just maybe it's not that interesting, but I find it very interesting, simply put.
Yeah, it's a couple things there, Dan. Like one, you touched on this a second ago, and why it's so hard to sell. There's that classic study where that basically showed just that, right? We tend to value things more that we already own or hold on to, right? So there's a study that showed, like, um, if you had a lottery ticket in your hand, right, what you'd be willing to sell it for, and that number is much different, right, than what you'd be willing to buy a lottery, buy that same ticket for, right? It's just the fact that you already have it; it's more valuable to you, and I think that absolutely comes into play. Um, yeah, it absolutely comes into play with securities you already own. The other point you made in terms of, like, I'm drawing a blank here. Trying to find. Um, that's what it was. The other point you made was on sort of mechanical rules and rule-based following and having those. And there was a great book I read earlier this year when we were thinking about this stuff. There's a number of great books on sort of market psychology. A lot of it, most of them are focused on sort of human psychology and what's known as behavioral finance and behavioral psychology in the industry. But I did a lot of reading over the last couple of years on, like, the trading psychology and how that impacts, like, how we think about position sizing and when to buy and when to sell. And one study in particular grouped traders into three buckets. They were called rabbits, they were called assassins, and they were called hunters. Um, and so how you rabbits were classified as, you know they didn't like being wrong. They were more interested in being right than making money, and so they couldn't stand crystallizing losses, right? So when something dropped 20%, you just kind of froze in your tracks. On the other side of that, right, you've got assassins, who are quick to cut losses. um, you know it's your typical sort of stop loss, right? Anything drops 20 to 30%, it's out of the portfolio. And then you've got the hunters, um, who will often, you know, they don't go all in on day one. This is most like us. They don't go all in on day one, and they allow themselves, if prices fall, assuming nothing else changed, to continue to build up the position, right? And often concentrate in their best ideas. And the big takeaway for me was, and right, not that one works better than the other, right? There's lots of different ways to make money in the market, and I think a lot of investing is finding what works for you personally and matching your investment style with your personal style. But what stood out to me was the folks that did the worst were those that did nothing, right? So like oftentimes when if something drops, let's use an extreme example, right? If something gets cut in half, it's probably safe to assume either A, you were wrong, and if that's the case, you should sell the position and move on. Or if you've got conviction and you believe you're right, if it's been cut in half, you should be buying more, right? And so I don't know if the lesson to be learned there and the results tell us that, right, mechanically one's better than the other. It may just tell us that if you didn't do anything, maybe you didn't have the conviction to be in the position in the first place, rather than like you need to do A or B. But that sort of a light bulb went off when reading that study, and so we tend to be. I, we try to force ourselves to act in one way or another when we see big moves in the portfolio.
Interesting. Wow. Thank you for that. I will be mulling that over. Do you know the title of that book off the top of your head with the rabbits and the assassins, or was it a study you said?
It was so the book, and I'll forward you. I've got sort of detailed notes on this one, which I'll occasionally do when something really resonates with me. I'll put together a write up and share with the team. I'll send that to you, Dan. But the name of the book is The Art of Execution.
Oh, okay. Art of Execution. All right. I knew I'd get a title out of you. Chris is always good for a book. Yeah, always good for a book recommendation. So thanks for being here. I do have one final question, though. It's the same final question for every guest. Like, no matter, even if sometimes we have a non-investment guest, and you can answer the question from any perspective. It doesn't have to be from an investment perspective. And the question is simply, if you could leave our listener with a single thought today, what would it be?
It's a tricky one. I wish I had a. I should have thought of this in advance, Dan. Um, we'll keep it to investing because I think it's important right now. I would just say be careful out there. Um, I think you know things have changed in the markets, um, and I think we're entering an environment where folks that learned the wrong lessons over the last 10 years may have several painful years ahead of them. Um, and so it's time to rethink those assumptions. I think I had this debate with a friend this morning over coffee about whether or not markets really have changed. Right? Are cycles really that much faster today? You can think about, well, I mean, COVID is an extreme example, which may not be representative, right? But that recession lasted all of a few weeks, and the recovery was just as fast. News cycles tend to occur much faster. Product cycles tend to occur much faster. Even what's popular on Spotify, right, is different from one day to the next. And so there's an argument made that things just happen much faster in the market, and so we've been trained to buy the dip over the last 10 years because every sell off is followed by a rebound just as quick. I don't think that's the case here. I think something has changed, and I think it's going to take time to flush out the excesses that we've built up over the last 10 years. Again, you go back to 99 2000 analogy, which we've been using for a few years now, and you could divide up that bear market, which lasted a good 2 3 years, into three phases. The first of which you saw the junk sell off, right? So it was the .com IPOs that just busted, that were up, triple digits on day one and continued to rise triple digits almost daily or monthly until they all went to zero. You had some survivors there, but right, the crap tends to fall first, and we've seen that with a lot of names in the market today, down 80-90% plus. The next phase of the bear market is you see the leaders follow. And I don't think I think we're just starting to see that crack. So you can think of the first phase as sort of, yeah, you see the correction in multiples, which you could argue we've seen, right? You've seen, especially in SaaS, you know, you had businesses trading at literally north of 30 times sales. You know, people would argue they're cheap today at 10 times. I don't know that's the case, right? Like there's that famous McNeely quote from 99, 2000 about companies trading at 10 times sales today. Like we still think 10 times sales is for some reason cheap. But the first stage is right that the error comes out of the valuations. I think we're largely, we've gotten there or largely way through that. The second stage is you start seeing the rest of the market follow suit, from most of the junk in the market, and that comes when we start to see earnings revisions. And I think you're just now, we're on the front end of that, right? So the multiples fall, the P and the PE falls, then the E and the PE falls, and then you get the last stage where it's just capitulation and everything falls together. And that's going to take time to play out. So I think, you know, if you use that as the analogy, which I think is still a very good one, you know, we're about a third of the way through this mess. And you know, be careful out there.
Well said, and I couldn't agree more. So, hey, great to talk with you, and thanks for being here. I always enjoy hearing from you, and whether it's email or presentations or here on the show.
Thanks, Dan. Appreciate it. Thanks for
You
having
bet.
us.
And we'll definitely do it again. Maybe I won't wait like a few years or whatever it was. Maybe we'll get you back in 6 or 12 months and see what's happening.
And in the meantime, we'll see you in a few weeks.
Yeah, see you in a few weeks.
All right. Thank you.
All right, thanks. Bye-bye. One of the reasons I enjoy talking with my friend Chris is that he is very, well, you heard it. You heard the way he speaks. Measured, disciplined, thoughtful, thorough. He strikes me as a man who, he knows who he is, he knows what his style is, and he does that every day. And I've enjoyed his presentations at the conference we go to every year. And I've enjoyed his book recommendations. He's a voracious reader. If you go to Broyhill Asset Management website, there's some, you'll find their little book club, and there's a whole list of books there that they've read and that he's read, and you know, he's discussed them with his team at Broyhill. And you know, great guy, as you heard, great guy. Really good idea on the airports. I thought that was a wonderful idea. I've heard it from others too. I know Chris Mayer has bought at least one of the Mexican airport stocks. So it didn't surprise me at all when he started talking about it. But yeah, great talk. Pretty darn good answer, you have to say, to the final question as well. Right on the same page as I am here on the podcast. So great conversation. Hope you enjoyed it as much as I did. Let's take a look at the mailbag. Let's do it right now. Look, I think you know by now, I'm always trying to tell you the really hard truths, even when, especially when, what I have to say is unpopular. Today, the hard truth is that your wealth is in danger. Everything you may have made in the bull market of the last decade could disappear very quickly. Some of it's probably gone already. This process has already started, and even if the financial markets somehow avoid a devastating crash from here, inflation is still eating 8% of your money every year. I've spent 20 years helping people prepare for extreme market shifts, just like the one we're going through right now in my role at Stansberry Research. I've recommended 24 double-digit winners, and I called the collapse of Lehman Brothers with near-perfect timing. Well, today I'm issuing my biggest warning ever. If you want to preserve your retirement and your lifestyle in the coming years, you need to act. I recently went on camera to lay out a simple one-step plan for what to do. You can set yourself up in minutes and likely forget about inflation, rising prices, or the worst effects of a market crash for years to come. This plan does not involve options, shorting, crypto, or anything complicated, and it doesn't require perfect timing. The perfect time to act is right now, and you could see triple-digit upside in the coming years. To watch my full interview with the brilliant financial journalist and hard asset expert Daniela Cambone, simply go to www.crashprotection2022.com. Again, that's www.crashprotection2022.com to watch our full interview for free. In the mailbag each week, you and I have an honest conversation about investing or whatever is on your mind. Send questions, comments, and politely worded criticisms to feedback@investorhour.com. I read as many emails as time allows and respond to as many as possible. You can also call our listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. First up this week, I have a bunch of questions from our faithful listener and longtime correspondent, Lodevik H. And I want to go through those. And Lodevik does a great job because this is not a long email, and he packed a bunch of questions, so many that I couldn't take them all. So I'll take as many as I can here. The first one is, should you have a 401k? I believe this is a tax-deferred investment strategy, yes, but why pay tax? Go offshore and consider a nomad lifestyle or a digital nomad style. Yes, Lodevik, those are two different things, I think. I talk to a lot of people who live in various places around the world, and they have different reasons for wanting to be there, and other folks who are of a mind to want to minimize taxes and so forth, but still live in places like California or even Oregon or some U.S. state or another, and they say, well, they tell me, my whole family's here and my business is here and my life is here, and that's just the way it goes. So they're two different things, right? That nomad lifestyle versus having a 401k to minimize your tax burden. And I think if you're going to hang around, you should have a 401k. Your next question is the real winner of the lockdown not rural real estate? Away from the city, no more expensive apartments, et cetera, et cetera. And yeah, I think in two ways, right? Because the value of it goes up, and the benefit of it, as you said elsewhere in your email, is that you're away from the big city. And my wife and I made very much that move. We made it so we could be closer to our grandchildren. We went from 0 to 5 grandchildren in world record time. All 3 kids had children within like a year and a half or something. And we lived near a big city that was where they were rioting every night for months and months and months. And we were very happy to get away from that. My wife was not happy there at all. I wasn't thrilled with it, but I could have stayed. But she was unhappy. I didn't like keeping her in that place, and she didn't like being there. So yeah, I'm with you. Rural real estate. Your next question here, and I'll take 2 more. You have several, but I'll take 2 more. More, and then you're asking more money in 1 year than in 19 years. And folks, what Lodevik H is referring to there is I've said it a few times on the podcast and elsewhere that it was reported, I think it was a Bloomberg article last November, that people put more money in the stock market in 2021 than in the previous 19 years combined. Did I say 19 when I read your question? Yeah. More money in 1 year than in 19 years, you said. And you said, well, that is my signal to walk away. Sorry, I'll take that back. You run away. And then you said, oh, wait, I'm out of the market. And and so, good for you. You were out of the market before all this crashing started happening. And yes, that was the moment, because it was reported in November when the NASDAQ peaked. And that was when the top really started coming in the broader indexes. So, yeah, that was the point of reporting that statistic. Walk away from all your speculative garbage and everything but the highest quality stocks. I'll take one more question, Ludwig. Actually, two more. Sorry, I did have another one after this one. You said, what caused the 87 crash? And you said you were 1 year old. So any insights and experience is more than welcome. Nobody really knows. People say it was program trading, and other people say other reasons, but nobody really can tell you about the 87 crash. But it didn't start here. It started in ex-Japan Asia and moved west and then wrapped back around to Japan. So, it wasn't program trading because there were all kinds of markets that were crashing like crazy. Anyway, one more. You said, hi, Dan. Yes, I understand free cash flow. Just a question. Why put money back to the shareholder in a crisis? Buy competitors who add something of value. Ludovic H. Thanks for all your questions. That last one, yes. If a business can take the free cash flow they're making in a bear market or a recession or a crisis and buy a competitor, that's great. In fact, really great businesses do that. They get stronger during the recession. Their competitors weaken and go away, or they acquire them, and they come out of the recession much, much stronger. So you're absolutely right. And we recommended like several businesses in the past year or two in extreme value for that exact purpose of holding them for the long term and watching them exploit the crisis by acquiring competitors or simply growing market share when competitors disappear. Next and last this week is Zach R. Zach R says, hi, Dan, I'm a big fan of the show. I wanted to hear your thoughts on the recent all-time low in the University of Michigan Consumer Sentiment Index. It goes all the way back to 1952, so it seems surprising to me that it wasn't lower in the 1970s or even 2008. Does this surprise you? Historically, have lows in consumer sentiment been a good signal for being at or near the bottom of market sell-offs? I look forward to hearing your thoughts, Zach R. I'm not a big watcher of sentiment, Zach. I used to think it was really worth watching, but I'm not a big watcher of sentiment. So I can't answer your second question. I don't know. Probably yes, but sentiment is the problem with it for me is it's too volatile and spiky. It goes way down and way up and way down and way up. Even when you're in a bull market, it just seems to be all over the map to me. But in this particular case, you're asking about why wasn't it lower in the 70s or 2008? And I thought about it, and I don't know the answer, but I have a guess that I think is worth making. In the last 50 years, since the 70s, or even the last, 13 years or so, 14 years since 2008, what has happened? Well, I think people have lost faith in big institutions, like, for example, government, and even, corporations and things. And I think that's a big difference between now and then. So today, not only is their sentiment low, but their belief in anybody who could bail them out or help them is low. Okay? So I'm guessing, I don't know the real answer, or even if there is one, this could be a random, if I'm honest, it could be a random anomaly in the data and nobody knows why. But I'm going to guess that if there is a reason, that's it. And certainly, I don't know, is it controversial even to say that people have lost some of the confidence they had in those institutions like government and even, religious institutions with all these, scandals with priests and so forth? I don't know if it is really. I think people have lost some of their confidence, and some people have lost all of their confidence in these institutions. So that's my guess. It's a good question, Zach. I don't know the answer, but I'm glad you highlighted how low the sentiment is, right? And when I look around, for example, like look at, just to take Bitcoin, since I was talking about that earlier, it fell off the bottom. Like a trader will look at the chart and say, ooh, it fell off the bottom because there was some, a little bit of noise or support or whatever around 31,000, 30,000-ish. and we were sort of going sideways, 29, 30,000-ish, and then wham, all of a sudden, here we're 23,000 as I speak to you. So, who knows where the bottom is? I think it's between 3 and 12, and it doesn't surprise me at all that it's crashing. I recommended people sell it. I told you on the podcast, I recommended it in extreme value. We had bought it. It was up. We sold it. Wish we had sold a lot sooner. We'd had a much bigger gain, but we did what we did because we thought we were going to be holding longer. I just expected this thing to behave a lot different. I expected Bitcoin to kind of live up to its promise as either some kind of an alternative currency or some kind of a store of value, an inflation hedge maybe. None of the above. Absolutely none of the above in any meaningful way yet. And people who say, well, since it started in whenever it was, January, 2009, I think, it's, it's up extraordinarily, tens of thousands of % or whatever. Well, yeah, but let's face it, most people, you can just take a look at the chart and go, oh, okay, everybody bought at the top and now they've all gotten murdered. That's just the way it goes. So lifetime track records in an asset or a fund or anything, you got to temper it with reality. You could say the same thing about ARK Innovation ETF. It's probably up still 150 or 200% since inception. But as we covered here on the podcast, and I covered it in Stansberry Digest, all the money came in at the top, and they've been most of the people in that fund have been underwater for months and months, maybe a year already. So there's that. Anyway, Zach, you obviously got me thinking about a lot of stuff with your question, so that makes it an even better question than I already thought it was. And that's another mailbag, and that's another episode of the Stansberry Investor Hour. Hope you enjoyed it as much as I did. We provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and know anybody else who might like it, tell them to check it out on their podcast app or at investorhour.com. And do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @investor_hour. Have a guest you want me to interview? Drop me a note. feedback@investorhour.com or call the listener feedback line 800-381-2357. Tell us what's on your mind and hear your voice on the show. Till next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email. feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.